You're listening to Heritage Radio Network.
Welcome back to Business of Drinks. I'm Erica Duecy, here with my co-host Scott Rosenbaum. Today we're talking about something every founder deals with, but few really understand: the capital side of building a drinks brand.
That's right. We brought in the perfect person for this discussion. Our guest is Mike Solow, co-founder and partner at 99 Proof Partners and Cask. 99 Proof focuses on early and mid-stage investments in beverage alcohol. Cask is their venture debt arm, and they do everything from barrel-backed lending to real estate expansion financing.
Quite a mouthful. But what we love in talking with Mike in this conversation is that he sees what's happening on the ground. He reviews hundreds of decks. He talks with founders every day, and he has a clear view of what it actually takes to raise money in this environment.
And what it takes to raise money has changed a lot over the past few years. Investors are more cautious than they used to be. They want strong margins, clear growth plans, and founders who can communicate well. Mike says that most founders aren't fully prepared for the process of diligence, which is exactly why 99 Proof publishes their 40-plus item diligence checklist on their website. It helps founders understand the level of detail that investors now expect.
Yeah, and he also explains why equity has become harder to raise and why venture debt has really taken off. Valuations have reset, hold periods are shorter, and founders need capital structures that won't choke their runway.
We also get into how Mike evaluates founders, what he looks for, things like grit, creativity, and the ability to focus on what truly moves the business forward. He also shares some real red flags, things like messy decks, unclear storytelling, and anything that signals a lack of preparation.
What I also appreciate is Mike's optimism. Yes, it is a tough moment, but he also sees it as a healthy correction, one that rewards strong operators and clear strategy.
So, if you're raising money, thinking about fundraising, or just want to better understand how capital partners view the drink space right now, this episode will give you a crystal clear picture.
So let's get into it. Here's our conversation with Mike Solow of 99 Proof Partners and Cask Strength.
And now, a word from our sponsor.
You can't scale a brand without strategy, and Intercontinental Beverage Capital brings decades of it.
Their partners have led some of the biggest names in the industry: Coca-Cola, Red Bull, Coors, Snapple, and now they're helping emerging founders build toward that same level of success.
Just one great example, working alongside a founding team, they developed a full commercialization strategy that supported a multi-state rollout for a functional beverage, which was delivered on time and under budget.
From brand strategy and packaging to retail, e-commerce, and financial planning, Intercontinental Beverage Capital builds the foundation for real growth.
To learn more and set up a free consultation, visit inbevcapital.com. That's INBEV capital.com. And now, back to the show.
Mike, welcome to Business of Drinks. We're so happy you're here with us today.
Thanks, Scott. Glad to be here.
Yeah, let's dive in. For our listeners who might not already be familiar, can you give us an overview of what 99 Proof Partners does?
Yeah, so we're a boutique private equity group. We make small-ish investments in the beverage alcohol sector, somewhere between $500,000 and $1 million checks. We focus on emerging brands, high growth brands in the beverage alcohol sector across debt, equity, and real estate. And we also just recently spun out a debt-focused fund called Cask Strength. And so that one doesn't do any equity. It's purely debt.
Great. Let's go into those kind of two areas. So you mentioned that you make small-ish investments and you said private equity. Can you give me an example of what you look for when you make one of those investments? You mentioned the size of the check you might cut, but what do you look for specifically when it comes to revenue or category, margins, founders? How do you think about that?
Yeah, sure. So It's probably a continuum that makes sense to kind of reference. So at the beginning, when we first are forging a relationship with a founder or with a leadership team, we are of course looking for good resumes, a lot of experience. This is an industry that's can be pretty difficult if you don't already carry with you the relationships and the know-how. So we're definitely looking for folks that have that covered off on the front end. Margins is something that we get into kind of later on once we are able to get into a bit of a financial deeper dive, so we understand what levers are being thrown in what directions. But yeah, early on, definitely case volumes, revenues, those are easy numbers to talk through early on in our conversations. There's not a hard floor on the 99 proof side that we're looking for. We've done some investing earlier on in our tenure where the companies were not at $1 million. That's a commonly used number in our sector. We're definitely okay evaluating businesses that are not at $1 million yet in annual revenue or recurring revenue, but we definitely need to see the roadmap in those instances that they know the founders or the leadership teams, they know how they're going to grow the business, in what direction they're going to go. If the leadership team isn't built out yet, who's next and, what value that brings to the business. If they're earlier on and they don't have a ton of revenue to add to the story yet, they definitely need to be very, very dialed in to what the growth roadmap is going to look like.
And to that end, how do you define the boundaries of brands that you work with? Is it strictly alcohol? Is it a little wider? Is it all CPG? How does 99 Proof Partners think about that?
Sure. So for 99 proof on that side of the fence, we definitely are squarely in the alc bev end of things. And so even in our non-alc portfolio, it's still stuff that's, performing on the field as if it's alcohol. It's like an alcohol replacement type scenario versus getting into sports drinks and all that stuff. We don't do that. So it definitely has to be bar service, something you can find at a liquor store. And within that, 9 times out of 10, we're looking at alcohol as the primary thing that we're kind of using to give us that first hurdle to clear.
Sure, sure. And then you mentioned Cask strength, this other kind of side of the business that works in debt. Can you give me an example of like what that specifically means if I am, I don't know, a founder of a brand or I'm a distillery?
Absolutely. So there's some specialized asset-based lending that happens in beverage alcohol. And that's kind of what got us into the debt side of things. And so early on, we were doing barrel lending and in fact, still do kind of similar things now. That initiative has kind of grown into what Cash Strength is, which is not just barrel lending. It's more venture debt. We do things like debt restructuring and expansion, debt for expansion. Oftentimes there's a real estate play there, a rick house expansion, or perhaps something analogous to like a shopping center where a distillery or a brewery is going in, like thinking on the real estate end of things. Debt often can play well there. And then there's, for the producers, there's things like lines of credit or things that are specifically geared towards production runs or PO financing or something that's a little more repeatable than going PO by PO. Really what we do, kind of bumping up a level, is we work with smaller and medium-sized businesses to leverage something that's flexible. The thing that we've learned since we launched 99 Proof is that oftentimes things are tenuous at the beginning in these growth stage businesses. And if you do bring debt, it's got to be the right structure in order to make sense. It's got to be flexible and not so rigorous up front in terms of the payback structure, such that the business can be fed, or else the debt ends up sucking all the oxygen out of the room and the business fails. So we've learned that. We've seen it, a million times. And so what we're trying to do with Cash Strength is to present a debt option for these growth stage businesses that can make sense and really give them the gas they need to push the pedal down.
And I'm curious, generally, right, there are seasons for things. And I think a lot of founders more recently in the last year, 2 or 3, have found it difficult to raise equity capital. Is now kind of the season for debt, as it were? Or how have you seen the market evolve and what you do over the last 5 years or so?
Yeah. So An important caveat to how I'm going to answer this question is the setup on 99 Proof. So not a dedicated fund. So we're sort of the go-between between a deal, a potential investment, and then the investors. So we have a captive group of investors that we bring our post-diligence investment opportunities out to, and that's where the money comes from. So it's not just sitting ready to be spent. And in doing that or being structured that way, we are subject to the preferences of the investor pool more so than a dedicated fund that's really, upfront has already performed the act of raising capital. And now it's their job to spend it in a way that, that makes sense as the fund managers. And so each time we have to go out subject to macroeconomic constraints, or if there's headwinds in the industry, we have to be very reactive to that. So to answer your question then, Scott, what we're seeing on the equity side first is hesitancy from investors. There's been really a myriad of press that's come out over the last couple of years talking about the negative value cycles in bourbon as an example, or that there's headwinds in alcohol as a whole, or perhaps certain segments of our population aren't drinking the way that they would or could or should, maybe, depending on who you are. So those are all things that investors read and that we have to react to. And so we're seeing that rear its head into, at least in our business, in the overall number of investors that want to put money into beverage alcohol on the equity side, which is it's a long game. It's a long time between founding the company, getting started, and then you get your exit. For the most part, it's not like a quick tech unicorn deal, right? So that's giving investors some pause. What we are seeing is there's a lot of interest in venture debt. And so our Cask Strength initiative and similar initiatives are much more able to raise larger amounts of money. And so that on our side is kind of what we're seeing trend wise in terms of where investors are choosing to put their money. The caveat points to those overarching trends is that on the debt side, you're going to see bank type performance. You're not getting that 10, 20 times multiple on your investment that you can get on the equity side, depending on what round it is that you're participating in. There are still some stalwart, definitely venture guys that are investors in our Rolodex that their minimum floor is like 6 to 8x multiple on their monies. Debt just doesn't make sense for them. So that is the one caveat, that those guys that are really looking for a grand slam every time, debt's not going to do that.
Got it. Got it. Focusing back on 99 Proof's portfolio, as it were, can you share a little bit about what's in it, what brands, and maybe provide a specific example of one and kind of why you believe in it, kind of the rationale?
Yeah, so over time, we've participated in the high growth segments of the beverage alcohol sector. So we have tequilas, we have vodka, bourbon, we have wine. We're looking at segments that are solidly defendable, that people do self-identify. So as an example, when I'm cooking dinner, I drink wine, right? And there's millions of us that are out there doing that. And that gives that segment of the industry this gravity that is defensible. And for the most part, that's an underlying or underpin that we use when we're evaluating something that's new. So it can be a totally new product, but within a segment of the industry that's kind of ripe for disruption. So an example of that is canned wine brand that we invested in that you're familiar with, I think, called Archer Roos. And they're doing great. It's a great company and growing well. And early on, the growth story there, early on, they were doing big things, doing great things, but just small. And again, back to my earlier point, that we are able to invest in early stage companies versus something that's at a revenue floor. So for us, they were there. They had an exciting growth trajectory. It was a well thought out business and business plan. The founder and the leadership team were extremely dialed in. It's a confidence inspiring team, and it remains so today. And that was a lot of the early conversations, forgetting the actual numbers, the early conversations were kind of satisfied by those points, right? They were doing something interesting, disrupting the market to a degree. They have some IP behind what they're doing as well. So that was interesting. And so that was what helped us kind of get over the hurdle above and beyond just the financial projections, which are always just a thesis, right? So you really have to dig into the founder, leadership mindset. So, just a working example, but at a higher level, we're actively evaluating and participating in the highest growth aspects of the business, all the while trying to pay attention to, what's coming next as well.
Curious, when you think about portfolio construction, you mentioned that you've got investments in vodka, tequila. Does that mean if I'm a founder that's got a vodka, that's kind of off limits for the portfolio right now because it might cannibalize? Or is it more, let's place a few bets in the same categories, understanding that realistically not all will succeed or break through?
Yeah, it's a good question. Truthfully, I think there's a lot of fund managers out there that are trying to answer that same question. How overweight is overweight in tequila or in bourbon or in wine? I think you'll find that with a boutique like ours, it's really not possible to be overweight as long as you are not participating in the same category every single time. For us, I don't want to say that nothing is off limits per se. If we've made an investment in tequila, I don't want to say that we're not making any more investments in tequila. We are definitely looking to spread it around a bit, but just having one or two at bats in a given category, my argument is there's plenty more room for you to make investments there. Nothing is on the same exit trajectory at the strategic level as some of their investments are sunsetting. Others are just going through a sunrise. And so there's this commodity cycle as well that's going to affect things. So there's lots of other outside factors that can justify re-upping your position in a given category. And, at least in my experience, even two tequilas side by side, they're vastly different businesses. And the reasons to acquire them at the strategic level are vastly different as well. So we don't really shy away from that overlap.
Curious, shifting to the perspective of founder expectations, is there a standard percentage of equity that 99 Proof Partners looks to acquire when it invests in a brand? We often don't talk about things besides equity, but what is also important to you all in terms of protections, if any, that you like to see in place when you work with a brand?
Yeah, so I'll take the last part first. Protection wise, we're looking for what I would consider to be standard protections. We're not massive check writers, this fund. So on the equity side, I'm referring to, we're looking for proper valuations really, and doctrine that's not going to bust down our valuation in future rounds. We're not a group that tries to lead rounds as well, so we freely admit that some of the negotiating that we do on the front side of an investment is not as weighty or toothy as a large check writer or a larger VC fund, as an example, that's going to lead the round and kind of set the valuation. They're also going to set terms. So a lot of times we're participating towards the ends of rounds. And so our ability to kind of push and pull is just different at that point. We do take our sweet time going through diligence. We don't make any apologies for doing so. And just over the course of doing business that way, most of the time, the leads have already been established, terms have already been established, and so on. So we do take some comfort in investing in rounds where there is a lead that's a formal professional investor. So a lot of those terms, we're just reviewing them, making sure that we agree, not necessarily trying to create them, if that makes sense. On the on the debt side, that has to function a bit more like a bank, right? So you do see proper rates of collateralization, even with the amount of creativity that we're, able to leverage. There still has to be a protection for the investment, for the overarching banking entity. There's got to be some kind of protection there. We're capable of being creative in what that is and how we look at it in order to make insurances for the capital. But at the same time, we're still hamstrung that there's got to be some collateral.
Sure. I'm curious, you mentioned taking time with your due diligence process. And one thing I'm thrilled, and we'll make sure to link to this in the show notes, but 99 Proof Partners list their kind of due diligence process. And this is what AI was great for. I ran through AI and asked, how many steps? And it counted more than 40. I'm curious if you can tell me about how this process was developed. And do you think your process is unique in its rigor and comprehensiveness, or is this what brands should begin to expect as this industry matures?
Well, I think the most obvious answer to that is if you're a founder, you should do this. You should at least partially that way. We don't make any misguided aspersions that this is the most complete list of diligence items that exists anywhere. We publish it, though, for really just a couple of reasons. One, it makes our job much easier in order to properly evaluate an opportunity, a founder, an initiative, whatever it is. The more information that's available, the better. And so we like having that information out there because it helps people prepare to speak with us and truthfully to speak with anybody. I mean, we're a boutique and we are not capable of doing every single deal, right? In fact, the kind of the converse is true. There's so many opportunities right now. It feels like we're not doing any of them. So the people that do get on the phone with us, just by sheer virtue of numbers, you have to be so prepared in order to be ready for that conversation. And our thought process is more aligned with like, look, if we can help you prepare for us over that continuum, however long it takes you to be prepared, that'll help you raise money from anyone. If you're this prepared to go into a meeting with a one-on-one high net worth individual, you're going to crush that meeting. It's harder to raise money from institutional, and you'll still be prepared if you go through this amount of diligence and really to completion attack that list of 40 items. So that's why it's out there. I think there's value in it towards things that are just optical, like how you set up your own data room. I think that there's value in that list for that initiative too. And all of those things are little nuancy, sort of confidence inspiring items that can make a founder or a leadership team look a certain way before they even enter the room to make their pitch. So myself, my co-founders, we've all raised money in the past. Like we know what that is like sitting on the other end of the table. Again, it's supposed to be a resource or a service for the folks that are going to, go through that.
Do you find that most founders are or aren't prepared? Is there a gap between the expectation of yourselves and founders when they come meet together at the table?
Yeah, most founders are not prepared, not soup to nuts. And in today's world, even the ones that are partially prepared and partially unprepared and kind of get called on the carpet for that, it's just very difficult to raise equity, not just in our industry, but kind of everywhere right now. So again, it's this amount of completion that's very difficult, and it's time consuming and it's frustrating, and people are out there trying to raise money. And so you're attacking these kind of in parallel, and we get that too. But the ones that we end up getting on the phone with or getting on a Zoom with or a Google Meet, those founders are much closer to completion. And honestly, that's kind of what it takes right now in order to get it done. The thesis that we get put across our desk that's not well formed, not very thought out. It's just very difficult to get through a fundraise with that.
Very, very interesting. I want to switch gears and I want to try something that we haven't really done before, which is kind of, I'm not going to call it truly rapid fire, but kind of short answer, we'll call it. So this first segment, true or false, and give your, opinion after, share your thoughts, but I'm going to share a statement and you let me know, yes, it's true. Yes, it's false. Maybe it's somewhere in between, but your perspective. So number one, entrepreneurs, founders, they get to be their own boss.
False. 100% false. You always work for somebody.
All right. All right. Next up, investors love risk.
False. Nope. Not even close. Even the ones that want that like venture style return, we get into risk mitigation on the first minute of every call.
All right. All right. One more true false. Okay. A successful drinks brand can launch and be acquired in 5 years.
Nope. Like lightning strikes somebody every year, right? But the vast majority of us are not getting struck by lightning.
Fair, fair. I'm curious your expectations when it comes to maybe investing in a brand on the equity side. What is the rough timeline? Is there, obviously shorter is better from investment to acquisition, but what's kind of a realistic notion in your mind?
Yeah. So this is kind of one of the things that's gotten more difficult recently, more that inflation kind of started tightening everybody's belts at home, and the retail investor started disappearing like circa like 24 months ago, give or take. We initially brought out a 3 to 5 year thesis. When we bring an investment out, sometime within 5 years initially was what we were looking for. We feel that that's a realistic timeline given the growth trajectory of where these businesses are. However, the misalignment with investors currently is many investors want a harvest. When things are tough or they've deployed a lot of money within their own portfolios, they're definitely paying a lot of attention now, at least in our world, to getting the money out and possibly reinvesting it or doing something, brilliant with it. But nonetheless, that's kind of the verbiage that we're hearing in today's world. And so bringing out a 5-year hold period right now is like a non-starter. It's got to be shorter than that. So what you're seeing with funds like ours, where we are really at the behest of the investors, what they feel is important or what they think their needs are at that point in time, we have to keep that as the like number 1 and 2 bullets on our whiteboard every day, right? So for us, things that are going to exit, at least on thesis, or they're going to try to exit within 3 years, now not exceeding 3, is really what we're looking at. There are definitely opportunities. They're more privately shopped, at least in my experience, but there are opportunities to gain an exit inside of 12 months. These are things that are already inside the 20-yard line with their strategic, and they just need a little bridge or something like that in order to get over the goal line. Those are opportunities that we see. And so those are things that we're regarding with a higher degree of potential success on the equity side of things than the longer hold. Again, no caveat there is those venture folks that are looking at a minimum floor before they write a check. In this sector, you're not getting a 10x when it's going to exit inside of 12 months. That's not a thing. So, again, there's an alignment issue that funds like us have to overcome behind the curtain. And it's really important that founders or people that are raising money understand what that game is like, so your expectations can stay in alignment with reality too.
Gotcha. So we're not looking back 10 years ago and saying we're going to get a 20x return and exit. I'm curious around this perspective, right? Where do you look in terms of information when you want to cultivate your outlook? What sources do you turn to for data?
Sure. So we see a lot of decks, and decks are a great resource for us to be well read. So that's like a 2 birds with 1 stone kind of initiative, right? We're evaluating a potential opportunity, and in being presented that opportunity, we're fire hose style getting blasted with information about that segment of the market, the alcohol market in general, sometimes macro market stuff as well. And so the first answer, more succinctly, is just decks. All of the quoted or reference material in those decks gets read, even if it's fed through AI. We get the links, we read the material, we pay attention to the daily posts. I'll avoid calling them out by name, I guess, so I don't leave anybody out and they get mad. But we do read all the dailies across myself and my business partners. We try to be very well read. Me personally, I read macro market stuff. I'm looking at stuff coming out of other industries, and I'm also trying to pay attention to what's happening overseas as well. As you are very aware, maybe more than anybody, a lot of the raw materials used in the States, they originate somewhere else. And so whether it's tariffs or just commodity cycles or things that are happening further upstream that make the price of raw material X more expensive, we're trying to be well read on that too. So we understand what the trade winds kind of look like, and why the cost of glass or cork or something, or why there may be a shipping bottleneck. All those things affect our business really mightily, especially on the logistics end of things. So yeah, I would say mostly digital. But for me, more so than my partners, I would say, is I do a lot of face-to-face conversation as well. So when we do bring on a potential investment, when we start having a lot of phone calls and web meetings, I'm mostly the first person at 99 Proof or at Cask Strength that's on the horn with anybody. And so I get a lot of anecdotal information as well, which is all, of course, anecdotal, but based or steeped in reality somewhere. And so when you hear the same thing over and over again, then you could also regard that as a trend affecting, this segment of the business as well. So probably not a surprise. A convoluted combination of a lot of voice and then a lot of bedtime reading, downtime reading. Luckily, there's a lot of bite-sized material that's out there, and then that leads to more bite-sized materials. And so we freely admit to going down the rabbit hole pretty deep and spend a lot of time just trying to be up to speed on where the industry's going.
I love that. I'm curious. You mentioned you've got a healthy diet when it comes to decks. Given that you see so many, I'm guessing not just dozens. I'm thinking hundreds, if not more. Any kind of tips or takeaways for founders, or any red flags? What don't you like when you encounter a deck?
Oh gosh. Okay. Red flags. I could probably go on for days on that, but at the highest level, we expect a level of spit, shine, and polish when you make a one pager, a deck, an email. I come from the old school, which is not a 140 character world. And when you send something, at least in my world, when you send something out to somebody, it needs to be thoughtful. It needs to be spell checked. It needs to look a certain way. It needs to look like you meant to send that and you didn't hit send on accident. Definitely not free form, inline car crash of thoughts in the same sentence. That type of very programmatic, purposeful approach to everything you do, whether it's a LinkedIn message, an email that you're sending to introduce yourself and your business. This 2-sentence thing that we get is an auto delete for me. There's too much out there for us. It could be a great opportunity, but if you can't take the time to think through how you're communicating with somebody, then you can't communicate with me. That same thought process applies to presentations. I mean, this is a presentation. It's something that's going to live without you on somebody else's machine. So it needs to be professional. There shouldn't be spelling errors. You shouldn't use colors that blend into the background when it's an important point you're trying to make. Don't use fuchsia or highlighter yellow on a white background. Like, just pay attention or have somebody who understands that make the deck for you. And unfortunately, we do see a lot of stuff with syntax errors and, spelling errors. And, in my world, before you send a deck to an investor, you have like no short of 10 people read that. People that are not in your industry, so they can ask you like, what in the heck is this, right? And now you can see from their lens, like, that needs more explanation or needs to be said differently, right? So if you're not doing that and you're just blasting this information out there, then you're not doing yourself justice, and it's going to be an auto delete for somebody on the other end. So those, in a nutshell, like, those are red flags. The things that we do like on decks, the things that we do recommend, having a great flow. You can get out on Google and you can do some research on what a proper presentation flow might look like. How do you tell a story? How do you wind it through? How do you get to a conclusion that leaves an impact? All of those are 101, 201 level presentation tactics and strategies that if you're raising money, you need to be well versed in that, especially if you're the CEO and you're going to be involved in investor relations as well. So communications is part of your job. And if you are not good at communications, you are not going to be good at communicating with investors. You have to spend the time to learn those things. And it's truthfully something that I wish more people were told before they started their companies, because you're taking checks, you're taking people's hard-earned money, and you owe them professional communication in return for the investment, in addition to the hard work you're about to grind out, right? So that definitely applies to the presentation styles and the types of presentations that we're giving. Well thought out, definitely spit, shine, and polish, and really kind of sticking to the salient points, understanding that it is a presentation. You don't have to put everything down on a presentation. Give us the high points. We're smart. We'll read those bullet points, and then assuming that they're the heavy hitter bullet points and it's an interesting opportunity, then you'll get the chance to fill it in with the narrative. But the deck, it doesn't have enough room for narrative and bullet points and staying, under 20 slides. It just, those really long 40 slide decks, like, we can't get through them. So yeah. So hopefully that's enough tips for people to kind of drill down.
I love it. And let me know if I picked up on this implicitly, but a deck, as I understand it in the way you're describing it, And also my kind of belief is that it shouldn't need explaining, because in many instances, it's going to be mailed to the person reading it and no one's going to be walking them through slide by slide. That comes later. Am I right in understanding how you're thinking about that?
Yeah, that's how it works with us. Our view is that decks are a tool to get a meeting. And then when you're in the meeting, they're the tracks. Like that's what keeps you going towards the next station, right? So view it as such. View it as a tool. It's not a movie. It's a tool. It can't take you on this 120-minute journey. It's got to be succinct. It's got to be more like a very dialed in terms of what you're putting in there, very strategic in terms of the material that's there, and get the meeting. Close for the meeting. Don't, it's just, I wanted to get this on your radar. It's already on my radar. I don't have time for that. If you want to meet with us, ask us, be aggressive, and put us to a decision to either meet with you or to not. And that saves unbelievable amounts of time. And I always appreciate that. Save me time. It'll save you time as the founder, like trying to track us down, because, at our genesis, we're nice people and we want to help. And even to the point of like degrading our professional life, we'll try and find some time somewhere to meet with people, even if it's not a fit, because we have a Rolodex and we do try and help and we network and we tell people that, hey, I just had this cool conversation with this company. We're not investing in it. It's not a fit for us, but you maybe should take a look at it. Like all that stuff happens because people are in our ear and we do see value in that. But if you're not asking for something that's going to help your business, then we're just treading water.
I love it. I love it. So to save you time now, I'm going to do 3 more kind of rapid questions and then wrap up with one last one. So what I want to do now is kind of fill in the blank, and I'll give you an example here. So the hardest thing about beverage entrepreneurship is blank. And I might say something like being continually asked to make impossible decisions and trade-offs. So with that, I'm curious, if you fill in the blank, what do you find is the hardest thing for beverage entrepreneurs?
Prioritization. Making a list, let's call it a task list of the things that you're going to accomplish. We tranche these out, right? But the come hell or high water list, like no matter what happens today or this week, these things are getting done well. And then the other things. And the list of those initiatives and their stack ranking can be difficult when things are like flying at you and everything seems important. But at least in my experience, we've been fortunate enough to see founders that have been able to kind of tune all that out and drive hard towards those come hell or high water. Maybe it's only like 3 things really on a weekly basis, but those 3 things really move the needle.
All right. Next up, founders most frequently underestimate blank.
Time. In our world, there's 2 pieces of time. It's only going to take us X amount of time to raise the money. That's not ever accurate. And then how much time they get between rounds of raising money. We always sort of chuckle, like somebody's in the middle of an A round and they're like, we'll never need to raise money again. It's not a thing.
Yeah. Yeah. No, it's not enough margin business to sustain itself, if I'm not mistaken.
You're not mistaken.
Last one, fill in the blank. From an investor perspective, the most important characteristic of a founder is blank.
Grit or creativity. I guess you could argue that they're different sides of the same coin. For me, again, I guess for those that didn't capture this earlier, we invest in early and mid-stage businesses. And that looks like this for the business, right? You have a loss one day and it feels like 10 losses, right? But conversely, you have a win, maybe it feels like 20 wins. So the folks that are gritty enough to survive those down cycles and creative enough to find a way to get more up cycles, those are the ones that are going to win in this industry. I mean, this is a gritty, like, pack up your lunchbox and hit the door industry. And the folks that are going to get out there and grind, but they can kind of take a step up and see the field, so to speak. They can take advantage of opportunities and trends that are in front of them. They're creative enough to maybe create a unique approach that's relevant for their company, what they're building and their people, talent and skills that they've brought on board. That's a massive advantage versus the ones that are almost like programmatically just trying to do what worked for the last guy. Like that's very difficult in an industry that is a commodity. It's a commodity market, right? So it's always fluctuating. So I think that gritty, like creativeness, not a prideful approach, like those are all kind of ways that I would describe that same mentality.
Incredibly useful to understand that perspective. Wrapping things up, I'm curious if there's anything that you might share that, when looking at 99 Proof Partners, you're excited about in the future. What do you kind of see on the horizon? How do you imagine the next year or three? What are you looking forward to?
Yeah, for me, on the capital side, it's rugged and gritty right now too. And the things that we're seeing, I think, are not long term. They may be longer than short term, but I think honestly, this is a bit of a correction in terms of investment and valuation for sure in our industry. And honestly, if you can look at it like that, then it's a great time to be an investor. This is like buying real estate in like a massive downturn. So I think from an investor standpoint, it's a pretty decent way to look at it. You still have to be careful, and there are definitely some tough times ahead for some companies that are in our sector that are still not run as efficiently as they could or should be. And that's part of the correction I think that we're seeing is a lot of focus on EBITDA and bottom line margin, whereas before it was almost like just throw money on it and just advertise. Everything will be fine. So I think that correction is needed. You do need to run a good business in order to be a good business, right? It seems sort of simple, but very difficult to do when it's on the field. And so I see that as a big positive correction for our industry. I think the more that story gets told, the more investors even are willing to dip a toe that aren't today or that had experience in the past and kind of pulled back. I think that gets them back in. Plus, like I said before, valuation correction back into what could be normalcy, I think has been needed as well. And so again, current thesis, it's a great time to be an investor in this sector. You do need to be very smart about how you're looking at the, exit strategies and really, what that, 3 to 5 years is going to look like. But I see market growth coming. I'm not one that kind of really adheres to the clickbaits, the salacious, fire type of material that we've seen come out fairly recently. This is a cycle based industry. It's cyclical. And when you kind of dig in and ask layering questions underneath the world's on fire and you start asking why or what factors have led us here, you'll understand that these are all correctable factors that are undergoing a correction. So I don't think that a lot of the stuff that we see on the supply side is a forever trend. I am one that also doesn't necessarily agree with the younger kids aren't drinking anymore and all that kind of stuff. We're just seeing revenues stack up differently. It's maybe in that group, it's not a volume-based business. It's a revenue-based business because they're spending money. Right. So you just have to kind of take a step back and evaluate this stuff. And you'll see that the drinks business is still a good business. It's a big industry. It's a fun industry. And on our end, we're glad and proud to be a part of it. And I see really a lot of positivity coming forward over the next 5-10 years. If you can dig in and do the reading. So yeah, that's my take on things currently. There's tough spots everywhere, so roll up your sleeves. Let's get over it.
I love it. I mean, I share that optimism, and like you said, right? It's simple, but it isn't easy, and that is a very different, real lived experience for founders, for investors alike. Mike, thank you so much for joining us today on Business of Drinks. It was a real pleasure.
Thanks, Scott. Glad to be here. It was a lot of fun.
Thanks for joining us on Business of Drinks. Subscribe on YouTube at Business of Drinks Podcast. Follow us on Spotify or listen in on Apple or wherever you get your podcasts. Please tap the notification button so you'll be the first to know when a new episode drops.
And help us spread the word. Click those star ratings, give us a review, and share episodes or clips on your socials. It really helps us reach new listeners.
Finally, if there's something that you'd like us to cover on the podcast, tell us. We're at podcast@businessofdrinks.com or reach out via Instagram or LinkedIn.
We love hearing from you, and we respond to each and every message. Thanks, and see you next time.